Call to order. Hi, my name is David Weiskopf. We are here for the Retiree Benefit Trust, otherwise known as OPEB, committee meeting, Friday, February 11th. Time is 11:30, starting a little late. Location is the Chesapeake Building, and I will start with roll call.
Jeanette Cudmore, CFO.
Mike Hewitt, County Commissioner.
David Weiskopf, County Attorney.
Scott Ostro, Community Member.
Catherine Pratzen, Director of Human Resources.
And welcome to our new member, Mr. Ostro. And next, I will have the approval of the February 11th, 2022 agenda.
So moved.
Second.
I have a first and a second. All in favor?
Aye.
Aye. Ayes have it. Motion carries. Next would be the approval of the December 3rd, 2021 meeting minutes.
I move to approve the minutes of December 6, 2021.
December 3, I think.
December 3.
December 3.
Oh, they were generated on December 2nd.
Yes.
Yes.
I second.
We have a first and second. All in favor?
Aye.
Aye.
Ayes have it. Motion carries. Moving right along to the presentation by Mr. Wing.
All right, well, thank you, Mr. Weiskopf, and good morning again, everyone. So our agenda items for this meeting will largely follow the script from the earlier meeting. So again, your top book will be the Q4 investment performance report. And again, similar to earlier, you could grab Exhibit 2, flip that over. We'll start in the market environment again, specifically on page 9. And we'll get a little bit more granular when we talk about markets, just given the complexity of the trust itself relative to the LoSAP. But with that said, again, starting on page 9, where you see U.S. economy up there at the top, as I mentioned earlier, we did see a pretty strong rebound in economic growth in the fourth quarter. In fact, it came out just a shade under 7% at 6.9. That was well above economists' expectations of 5.8%. And again, the big driver of that was investments in inventory of private businesses.
Sorry, he's just getting there.
Oh, sure.
Might be in the wrong one. No problem. Yep, there we go.
I apologize. So again, this is on page 9, behind the second exhibit. Okay.
There you are.
So as I mentioned earlier, the private inventory investment from businesses really drove economic growth, and it's seen as a key driver as we head through 2022. And again, at the bottom of page 9, even though we had this large build in inventories, there is a long runway for businesses to continue to invest in those inventories. Here, just looking at the retail industry, their inventory to sales ratio, or again, how much they're carrying in inventory relative to sales, as you can see all the way to the right, really fell off a cliff amid its subsequent to the pandemic, given supply chain issues. So there is a long runway or broad scope for that inventory investment to continue as we head through the rest of 2022. But again, it'll largely depend on continued moderation or alleviation of those supply chain issues, of which have driven a lot of the inflation on the goods side of the equation for the current U.S. economy. And keeping on the idea of inflation at page 10, and we talk a little bit about in the first bullet point, the December employment report. It came in below expectations. January was much more favorable from the number of jobs added perspective, but the unemployment rate dropped to levels we haven't seen since pre-pandemic. And the other key dynamic as it relates to the labor market is the number of people in the private workforce quitting their jobs has just been at historic levels as they seek better opportunities, higher wages, or leaving the workforce entirely. And as I mentioned earlier in that top right chart, if you look at the relationship between the unemployment rate and the percentage of people quitting their jobs, it tracks each other very, very closely over time. But if you look at the top right, you see a notable divergence in that quits rate there in the darker line, really consistent with an unemployment rate of close to 1%. So it's just incredibly, incredibly tight labor market right now, driving wage growth really across all segments of consumers. And the concern, in isolation, wage growth is a good thing, right? People, more money in their pockets drive spending, but it can impact corporate margins, corporate profits, and then that would have an impact on, asset markets and asset performance. And, related to that, we've seen a lot of equity volatility this year, and it's really, we believe, the fact that the Fed has certainly underestimated these inflationary dynamics, most notably in the labor market, and now they are trying to not be as far behind the curve as they were, say, at this point last year. And right now, at the end of last year, we talked about rate hikes maybe in the 3 to 4 range, but as of yesterday, markets were expecting maybe 6 to 7 hikes this year, and that's caused a lot of the uncertainty, a lot of the angst.
You said that last time, and of course, I don't want to belabor it too long, but I do want to bring up something.
Yes.
The inflation is very real. Lord knows anybody goes to the grocery store or anything you're trying to do, it's very real. But my sense is, while people were locked down for a year, year and a half, 2 years, whatever it was, when we talk about the savings that was built up, $2 trillion or this astronomical great number, and now that people are coming out of that, they're out there looking for services, they're out there, putting additions on the house, renovating, doing whatever they're doing. They're spending that $2 trillion, okay? Now, that has forced inflation up because there's not enough materials out there to be had. So this idea that this inflation is what's the term? Transitory, I think it was the term I read. And now that we're thinking maybe it's going to hang around a little longer. But what I recently read in the journal was that debt is starting to go back up per household, and that $2 trillion is getting spent. So while wages are going up, which is a good thing, I think, it does put pressure on inflation, pressure on pricing. When this savings comes down, won't there be a point at some point where it kind of intersects or something?
Yeah, this is a great point. It will alleviate some of the pressure. So to your point, Commissioner, I read the other day, amid the pandemic and all the labor market issues, that in aggregate, you can think of it as lost income economy-wide of about 8%. But with all the stimulus, we didn't just replace the 8%, we actually doubled it, right? So it was sort of 15% of income. So to your point, that drove up the savings rate. So while we had the supply issues, and they were very, very real, it was also the demand side of the equation where demand increased incredibly high as well. So those two dynamics have really driven a lot of that inflation. And as those savings rates, absent any other stimulus, which I don't know if we can write off or not, who knows what's going to come out of Washington, but absent any other stimulus, then when the consumers draw down their built-up savings in the short term, it continue to pressure inflation a little bit. But over the intermediate term, if they don't have that extra dry powder to spend, then technically demand should come down a little bit, and then inflation will hopefully moderate.
Just not as fast as we thought.
Yes.
Okay, thank you.
You're welcome. So with that said, if you want to jump to page 12, just another couple quick comments about the market environment or from a capital markets perspective, and then I want to spend a little time specifically looking into U.S. equities on the next page. But as I mentioned earlier, if you look at the first 3 rows here to the chart on the right, U.S. international emerging market equities, the themes were consistent from a relative perspective. So U.S. the best of the bunch, international in the middle, and then emerging markets lagging. However, the absolute returns were much better in Q4 than what we saw in Q3. And when we think about the trust specifically, and we'll see this later on as it relates to asset allocation, we had an overweight to U.S. equities during the quarter. So having more money in an asset class, as you can see here, did the best amongst equity markets was helpful. And we also had an underweight to emerging market equities relative to the policy target. So having less money in an asset class that underperforms is also helpful. So those two key dynamics were tailwinds for the fund during the quarter. And then when we think about bonds, you can see U.S. bonds, they're flat for the quarter. And I didn't dig into this too deeply earlier on, but it's important to peel back the layer a little bit, given you see the return there at 0. So what that tells us is interest rates didn't do a heck of a lot at a high level, right? Because when rates go up, bond prices come down and vice versa. However, there was a huge differentiation of between what rates did depending on the maturity of a specific bond. So in other words, short-term rates, bonds maturing, say, in the 0 to 5-year range, saw rates jump notably at the prospects of the Fed raising short-term interest rates, whereas longer-dated bonds, say,
Stayed down?
10 to 30 years, actually came down a little bit.
Well, I saw that 10-year Treasury, which has always been a barometer for me in the time I've been fooling with this market stuff. It's up around 2% now. $1.92, I think I read yesterday.
Yeah, so in the Q4, they came down a little bit, but this year you're spot on, Commissioner. It ended yesterday north of 2%.
Because I think I remember last year there was like $1.27. I used to think, man, it's getting hammered. How long can it stay there? But now that it's going up, I just believe interest rates are going to go up, which is going to make our market valuations go down.
Well, I'll tell you, it's a real interesting dynamic. When you look at forward expectations for interest rates, specifically around what the Fed's doing. So as I mentioned earlier, the market right now for 2022 is pricing in almost 7 rate hikes. It's also pricing in rate hikes for next year. But when you look out to 2024, then it's actually pricing in the bigger probability of rates leveling out or
Drop.
cutting.
Yeah.
So when we see that, and if you look at other more nichier parts of the Treasury market, what you're seeing again in expectations out in the future, that certain parts of the yield curve are inverting.
What worries me about the Fed is sometimes they're too reactive to raise too quick. And then when the negative
Too slow to,
especially when you talk about doing 7 in a year, holy smokes. I
Yeah.
mean, you got to do, instead of doing quarter point, maybe you do bigger jumps to have a bigger negative effect on inflation demand.
right.
Well, look, I'm not on the Fed, but
Well, I don't know. I don't know that you want to be.
my point is I sometimes worry about those people.
I know. So to your point, and I know not to go too deep down the rabbit hole now, but if you think about 7 hikes, there's 7 meetings left this year. So they could do a quarter point at each meeting, but also the market right now is pricing in almost the 100% probability that they do 50 in March. So again, just this uncertainty about the magnitude and the pace, the timing, and things of that nature have really driven these, the volatility within equity markets and some of the rate increases we've seen on the longer dated bonds, at least this year, that we didn't see in Q4. With that said, just quickly on page 13, before we get into the data, I want to talk a little bit about U.S. equities, and specifically that second and third bullet there was really interesting dynamics within the market. And again, this is relevant for the trust since they have a number of managers in the U.S. equity space. But as we note in that second bullet point, growth stocks and large caps were the best performing segment during the quarter. And it was really those large mega cap tech-related names, the Apples, the Microsofts, the Googles, the Facebooks, that did very, very well in the fourth quarter and drove a disproportionate share of the gain. So why that's relevant is there's an active large cap growth manager, Brown Advisory, and they tend to underweight those names because the largest 5 stocks in their benchmark constitute more than a third of the overall benchmark. So many active managers like them, just from a risk management perspective, won't hold 35% of the portfolio in just 5 stocks. But when those stocks do the best and drive a disproportionate amount of the gains, it's going to be a headwind for them.
Looks pretty smart then, doesn't it?
Well, it looks not smart now, but when those stocks go in the other direction, then it will look smart. And that's pretty paramount to most active managers. They don't want to hold those securities in such a large weighting as the benchmark, just from a risk management perspective. So that was a headwind for them, but really interesting. That was in the large cap space, but in more mid and small cap companies, it was value stocks that did better because a lot of the pandemic winners, right, the Zooms, the Pelotons, the DocuSigns, that were supposed to have these secular tailwinds from staying at home, working from home, e-commerce, things like that did so well amid the pandemic and earlier in 2021, really took it on the chin in Q4 as the economy, was building towards reopening and the Fed was going to start raising interest rates rather dramatically. So why that's important is the small cap managers within the trust have more of a higher quality type of approach. And those profitless tech stocks that I just referenced earlier are more of a lower quality type of animal. So their approach focusing on what did well, as we'll see here in a minute, was very helpful for them relative to the benchmarks and relative to the peer group. So really interesting movements within the U.S. equity market, and wanted to provide that context for when we see the data for the managers themselves. So with that said, let me pause to see if any other questions or comments as it relates to the market environment before we jump into the trust itself. Okay. So if you can grab Exhibit 3, flip that over, we'll look at page 19 quickly. Again, some just qualitative information, some of which I've already outlaid here, and then we'll get into the data itself. So you can see up top under observations, the market value of the trust was a little north of $127 million at the end of the year. We'll give you a more up-to-date look at that here in just a minute. The portfolio had an investment gain of $4 million and a return of 3.2% net, again, more or less in line with that policy benchmark of 3.3. But in that sub-bullet point, again, worth repeating, and we'll illustrate this again shortly, we don't have the private market values as of December, so that 3.2% return is going to be pretty drastically understated given how much the private markets comprise of the trust itself. So it's always important to have that in the back of our minds when we're reviewing quarterly information, but we don't have up-to-date information for almost 20-25% of the trust itself. As far as from an attribution perspective, again, what helped the trust versus the benchmark and vice versa. On the positive side, I hit on those first two items already. And then in that third bullet point, I'd mentioned the outperformance by the small cap managers and actually outperformance by the non-US equity managers as well. On the attribution side, I had mentioned Brown within large cap growth, the dynamics around that. And then two of the fixed income managers were a little bit behind their benchmark because of those interest rate dynamics. They tend to be a little shorter duration, so have less interest rate risk than the benchmark. And in doing so, you generally have more allocated to shorter term bonds than longer term bonds. And since rates went up for shorter term bonds, those prices came down where they were flat, or actually the prices increased a little bit for longer term bonds. So their sort of positioning across the yield curve, if you will, was a headwind for them given what rates did during the quarter. If you look on page 20, again, just a snapshot up top with fourth quarter under that summary of cash flows. So we began the quarter at $123.2 million. See a little bit of a cash outflow for expenses and fees, but that investment gain more than offset that. So all told, the trust grew by about $3.93 million during the quarter. The returns in the middle of the page, we'll hit that in just a minute when we look at the peer rankings, but again, as the asset allocation in the table below, with all the asset classes listed to the left, their current policy targets, and then the difference to the right is just a dollar perspective. So if it's positive, as you see in that top line, in other words, we have $5.7 million more in U.S. equities compared to the target, just putting those percentages in a dollar perspective. And as you know, a lot of the negative numbers, when you work up and down that right-hand column, the first big one you see is an emerging market, so that'll come into play when we talk about rebalancing recommendation. Hedge funds below that, down below $4 million. If you recall, hedge funds are not a part of the new investment policy statement, so we exited the loan manager there, but we're waiting to update the statement before we move things further in line. And then the other key takeaway, private equity, quite a bit north above its target, but on the flip side of that, private real estate quite a bit south. So obviously the private real estate number, the hedge fund number, that money has to go somewhere, right? And a lot of that underweight is concentrated in the U.S. equity segment now because that's the direction that we're headed with once we execute that new investment policy statement. So on the next page, quickly on 21, I think, just illustrate your comments earlier, Commissioner, in the LOSAP meeting. You can see here the historical market values of the trust itself. So you can see towards the top right of that chart, we're at a high water mark now at the end of the year and almost doubled in value just in the last 5 years alone. That's the time period for this chart. And if you look all the way to the left there, we were at $65 million at the beginning of 2017. So obviously, coming through contributions from the county and as we talked about a little earlier, strong market performance over the last 4 or 5 years. With that said, if you could jump to page, let's see here, we'll look at the peer rankings on page 27. And I'm going to kind of flip back between 27 and 28 here just to provide a little bit more context. But like we talked about earlier, again, we're essentially comparing the trust from a return perspective to other similar public funds that participate in this universe, of which there are many hundred. And again, the key takeaways are the circle and the triangle below. So as you work away from left to right, you see the 3.2%, again, as I referenced earlier, was in that bottom quartile at the 83rd percentile. Now, with that in mind, if you look on page 28, just want to give you a quick illustration of, the historical revisions that we've seen. So on page 28, again, those bottom two lines, you can see this is third quarter data, where we ended up at 1.1%, which was good for the top 6 percentile. When we had originally reported those numbers, it was actually down 0.8% because we didn't have the private market investment. So we got about a 2 percentage point upward revision in that return. So again, even from a conservative perspective, if we, again, look on page 27, that 3.2, I think it's reasonable to expect eventually to get upwards in that 4.95% range once we get those numbers. And then, as we've had in the past, sort of that top quartile quarterly performance. Now, sticking on page 27, you can see the fiscal year to date there. We're at 4.3, at least through the end of the year, a little bit ahead of the median. And then the 1 year, obviously, calendar year of 2021, pretty much our relationship with you all so far at 17.6, ahead of that benchmark there and good for top 4th percentile. And then as you work your way from left to right, as you all well know, the trust has done very, very well relative to that benchmark and relative to the peer group over time, helping it grow into that very, very strong and healthy funded status as we sit here today. Any questions or comments around that before I jump into the managers?
Well, that's what I would say, Scott, is see how 7 years ago we were number one? Mm-hmm. And now we're number, 83?
3, yeah. You mentioned that in
Looks
the other
bad.
meeting.
Looks bad. But on the other hand, we gotten to where we wanted to go.
Right.
So we shifted our paradigms on.
And that's just because
lower-
you leveled off what you.
Well, lower our risk assessment.
Yeah.
Exposure. Right.
And Pat,
To be clear, you weren't number one 7 years ago. You've been number one over the cumulative period.
Well,
for 7 years.
Okay, Mr. Ritchie, you're right. I guess my point of the thing is we've shifted from probably a more volatile, more aggressive policy to a less aggressive policy. Now that we've gotten to our goal.
Right, not only the goal, but, and I don't want to scoop Mr. Ritchie here, but with the prospects of needing liquidity, right, from the fund itself, moving from a pay-go to, a general reimbursement type strategy, dialing back some of the more liquid hedge fund exposures, the private markets.
Risk.
Right, trying to, now that can only happen over time, just given the nature of those investments, but that's the direction that we're headed, essentially to build on Commissioner Ewan's comments, moving from, say, growth-oriented posture to a grow and protect, if you will.
and would you just describe that the role the private equities play and the fact that we don't have those returns? So I don't know if Scott understands that or has seen that yet.
Sure.
Lag.
Yeah, so they're not included in these returns.
Right. So just the nature of those types of investments, they're reported on a lag. So generally a quarter behind, everything that's liquid here. I mean, the impetus for making an allocation there is that you have to tolerate the illiquidity, but you'll be compensated via higher return than public markets. And I'll hit a couple pages and we'll see that over time. But to Ms. Pratton's point, that's why we show the previous quarter's revision. Mm-hmm. So we were at -0.8 and we finished at 1.1. Right. So given how much of those assets comprise of the total trust, it has a very material impact once we get it in those numbers. So we had a 2 percentage point revision last time, even being conservative at 1.5, Q4 might ultimately end up closer to 5 than where we are right now. So it's always important to take a look back to and see that impact and then take it into account when we're looking at the current numbers as well.
Understood. Thank you.
Okay.
Thank you for that clarification.
You're welcome. Okay, so I'm sorry, are there any more questions or comments before we continue? Okay. So we look at page 31, please. Just a couple quick comments on some of the managers, and then we'll show you some information around the private markets to wrap up the report. So the top of page 31, where you see the dark gray line there, those are the total trust returns that we just reviewed. And then each other gray line will be an asset class. So you see U.S. equity composite. So that's just a weighted average of the managers beneath that you see in lighter gray before the next composite. So the U.S. equity composite return for the 3 months was 7.7 versus 8.8 for the benchmark. Again, if you look in the middle of that U.S. equity composite, that third lighter gray line or row down where you see Brown Advisory Growth, they made money during the quarter. They're up 5.4%, but they were about 8 percentage points behind the benchmark. Again, because they only have about 10% of their portfolio allocated to those 5 stocks, which comprise 35% of the index. So that underweight pretty much explains all that underperformance. And if I don't have it in front of me, but if we saw the ranking of the benchmark itself, I'm sure it would have been top 10 or top 15%, just given it's so concentrated. And again, those largest stocks led the gains. But on the flip side of that, again, sticking in U.S. equities, a couple of the lighter gray lines below that, you see William Blair, and then the small cap growth manager Freese under that, as I mentioned. William Blair comfortably ahead of their benchmark, and Freese well ahead, again, given their higher quality type of approach, avoiding those lower quality names in that universe. Again, higher quality stocks did quite well, so it was a pretty favorable environment for each of those two respective managers. Then the last darker row there, the non-U.S. equity composite, weighted average of the 3 managers in that space. So the first one, Schwab, that is a passive fund, so that's expected to mimic the benchmark over time. There might be slight deviations in the short term, but over the long term, it'll be pretty much spot on. And then that's complemented by 2 active managers there. You see Dodge and Cox and WCM, and for the quarter, both managers posted returns comfortably ahead of the benchmark, particularly the case for WCM, really benefiting from some strong stock selection during the quarter. On page 32, the first composite up there, emerging markets composite, you could see more or less in line with the benchmark. That's really owed to the fact that even though there are 2 managers there, you can see the first being Invesco, and the second, Vanguard FTSE Emerging Markets ETF. That latter, Vanguard fund, is a passive fund. So those returns, again, over the long term, won't terribly deviate from the index itself. So in the short term, again, we could see the slight deviations, but the passive fund makes up about 70 to 75% of that overall allocation. So it'll largely track the benchmark over time. It's a similar story within U.S. REITs there. You see the second darker row. That is also a passive investment, up 15% in line with the benchmark. And having that allocation was helpful because, as you noted earlier, U.S. equities were up a little bit north of 9%. So REITs being a sector within the broader U.S. equity market, that was about 6 percentage points ahead of the broad U.S. equity market, at least for the quarter. So on page 33, a couple comments on fixed income, and then we'll look at the private markets just to round out this conversation. So the fixed income composite or asset class is sort of the third darker row in the middle of that page. You can see the weighted average of those 3 managers down 0.2% versus the benchmark that was essentially flat. So the first 2 managers there, the Delaware Diversified Income Fund and then Lumisale Core Plus Bond Fund, they track the benchmark for the asset class. In other words, that aggregate bond index. So they were a little bit behind, again, largely due to the reasons I outlined earlier, having more invested on sort of the shorter end maturity type bonds where rates had increased, rather on the longer end where rates actually came down a little bit and bond prices rose. Now, the final manager there, you see Lord Abbett. They're more of a short-term manager, sort of in the 1 to 3 year space. And the reason we had recommending adding Lord Abbett, whereas previously it was just these 2 managers, was because of the fact of, or the prospects of rates rising. So it was a little bit of a headwind in the 3-month period because they're focused on the short end, and that's where rates rose. But they did manage to, navigate that environment fairly well relative to the benchmark. You can see they're 0.4 percentage points ahead of the benchmark during the quarter. So sort of the fixed income structure was a headwind in the quarter, but now that we've seen rates rise here in Q1, it's going to be the mirror image of that, right? Having less interest rate risk, and with rates on the longer end moving up quite dramatically, having that shorter duration or less interest rate approach, we're pretty much seeing, again, the mirror image of these numbers as we're seeing in Q1. So just a couple quick comments on the private markets. So on page 34, we show the private equity composite. So on the left there, you'll see the investment names. So these are all the funds that the fund has made historical commitments to. Next to that, you see the vintage years. That's essentially when the fund got off the ground running. But the key takeaway is really in that bottom blue bar where we're summing up everything up top. So the important data points in those blue bars, number one, you can see the commitment under commitment, or the first number in blue. That's the aggregate commitments that the fund has made to the various managers above, a little north of $21 million. But more importantly, the unfunded commitments. So what's left for them to call, or money left for them to ask for. So that was $4 million at the end of Q2. It's about $375 now. So as this sort of asset class or program is maturing, we'll expect more money coming back to the fund than being called by the managers themselves. And then finally, as you work your way from left to right, you can see the cumulative contributions at about $19.16 million. So that's how much money the trust has contributed to the managers. To the right, you see distribution, so how much has already come back. And then finally, in valuations, $25 million. So if you add up what you've gotten back and what's left valued on those manager statements, that's about $38.5 million. So in other words, that $19.16 million has doubled during this period from these managers themselves. So it's always important to, recognize the fact of, what's outstanding and, what could be coming down the pike as far as capital calls, so we can manage the cash situation and things of that nature, but also over the long term, how accretive has something like this been to the fund, and it's been very accretive over time.
Yeah, that IRR continues to
It does.
healthy.
It does. So, we talked about before that IRR, so it's the last number over to the right. Excuse me, it's a little different than the returns on the previous page. So since these managers control when to ask for the money and when to send it back, essentially that calculation takes into account how much money they're managing at one time, because they control the cash flows. So it's a little different than the returns on the previous page, because you control the cash flows for the mutual funds, when to add and when to take it back. So, a good, number there, again, you want to be compensated for the illiquidity, is probably in the, 14 to 17% range. And this is upwards of 25, has, been very accretive over time. Now we would, like to dial back expectations moving forward. So if you think about making these commitments a lot in the early 2010s, when the public market was much lower. So what does that mean? As the markets ramped higher and higher, when these funds made investments earlier, it's been a very attractive environment for them to go sell them now, because valuations have gone up so dramatically. So, put simply, this from an absolute perspective is probably going to moderate as we head forward, but we still think that it's going to provide a consistent premium relative to what we're going to get on the public side. And then quickly on 35 and 36, we'll start on 35. So this is the same idea, but just for the private real estate composite. If you look all the way to the right in that bottom blue bar there, you see the 14.4, or the IRR for this program. So it's lower than the 25. We would fully expect that, given this is real estate, not private equity. A good range in here is probably more in the 11 to 15% range. So we're upwards of, to the higher end of that range, and that's up from 13.3% in Q2. So that asset class continues to do quite well. And then to wrap up on 36, again, same type of data and analysis, but for the private debt investments. All the way to the right, again, you see that IRR a little north of 10%. Again, since this is a debt investment and not equity, we would expect it to be lower than the other two, but a good range or of an expectation of what you should get is probably around 8 to 12, about 8 to 12%. And we're right smack in the middle of that. So with that said, let me pause there. Any questions or comments before we continue with the rest of the agenda items?
Not for me.
Nope. Thank you. I would like a motion.
I'll make a motion to accept the fourth quarter investment performance report from Marquette Associates.
Second.
We have a first and second. All in favor? say aye.
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 Aye, ayes have it. Thank you. Motion carries. Next part of the presentation is the recommendations.
Yes, sir. So this is in the second book. If you would grab Exhibit 1, flip that over, and then we'll start here on page 4. So in the, let's see, 1, 2, 3, third column from the left, you'll see the total assets number, about $122.3 million. So as I mentioned, we were at 127.1 at the end of the year. So much like the LoSAP fund, we've seen pretty much that investment gain, pretty much wiped out here in Q1, given the equity market volatility. You could see a specific rebalancing proposal in the middle of the page. Before getting into that, though, a couple of quick things to mention, again, on this bottom left-hand chart that you see at the bottom of the page. So again, similar, as you all know, all of the asset classes listed there in black, current allocations, black, targets in blue, and then the differences in red or green. So again, consistent to what I mentioned previously, if you look at U.S., developed, non-U.S., and emerging market equity, we have an overweight there, because that's the direction we're headed, to improve the liquidity of the fund itself, whereas most of the underweight is really found from a little bit in fixed income, some in high yield, which is really private debt, and then private real estate itself, hedge fund again, given that liquidation, and then a decent overweight to private equity. So again, the real estate and the hedge fund underweight has to go somewhere. A lot of it's in U.S. equities right now, and a lot of it's in cash as well. You see at 2.5% of the total trust, because there's no target right now, but we do need to keep a decent amount in cash because of the private market calls and distribution, some uncertainty around that. So as far as the proposal itself, you can see in the rebalancing column, specifically proposing a redemption of $1 million from the Vanguard S&P 500 Value ETF, and having those funds go in the FTSE Emerging Markets ETF, really for two reasons. Number one, what we've seen so far this year, unlike in Q4, value stocks have ripped ahead of growth stocks. So that investment relative to Brown, your active manager, is come a little bit disproportionate as things stand now. And the secondly reason is emerging market stocks, as I mentioned earlier, were huge laggards or underperformance last year. So this is really at the heart of it, just selling high in an area where we're a little bit overweight and buying low in an area that we're a little bit underweight. So we're not selling equities, right? We're just changing the mix of equities themselves. And normally...
Rebalancing.
Exactly. And normally we would usually have a recommendation to draw that cash down a little bit, but as I mentioned earlier, I think given the environment right now, I think it makes sense to have a little bit more flexibility.
Well, what about calls? Do you think, I saw you talked earlier about calls. Do you see those coming up sometime soon?
So we actually processed a couple yesterday. We've also seen some recent distributions. So I think the cash number is actually maybe a couple $100,000 higher than that as we sit here today. So between now and when we meet again in April, I don't foresee any issues around.
Okay, we can fluctuate then.
Yes, sir.
Well, I'm going to make a motion that we move $1 million from Vanguard S&P 500 Value ETF to Vanguard FTSE Emerging Markets ETF.
Second.
I have a first and a second. All in favor?
Aye.
Aye. Ayes have it. Motion carries.
All right, great. So then our next item is the investment policy statement review. So again, like we discussed at the earlier meeting, there were no comments or questions that I was aware of. So today, like we did for LoSAP, I had a draft with track changes and then a clean draft. But like we discussed earlier, I think it would be prudent, given timing and then again those investment ETF vehicle considerations, to formally execute this at the next meeting, where we can have recommendations to more align the fund with the new asset allocation. So again, let me pause. I'm happy to answer any questions or comments if there are any, or any comments about that proposal of formal execution and recommendations in April.
I made mine last meeting.
All been covered.
All right. So then to wrap up, next steps, again, just to echo my comments quickly earlier, and this is on page number 8, I'd mentioned earlier around the custody RFP updates, we continue to make good progress there. Still on track for that award and transition in Q2. At our next meeting in April, like I discussed, we'll bring a clean copy of the IPS for execution and recommendations, and then subsequent to that, similar story around the custody RFP update, how that's unfolding, keep the board apprised, recommendations, and again, as I mentioned earlier, to the extent that we have time later this year and the board's still interested, we can have that traditional versus OCIO discussion. But again, I think there's a lot of meat left on the bone for us to tackle first before even considering whether the board would like to have that discussion. So with that said, let me pause here. Happy to answer any questions or comments, but that wraps up everything from me today.
Thank you.
I'll make a motion, we accept the fourth quarter investment report for Market Strategies, Market Associates.
I'll second.
Oh, do we need that, Michelle?
We didn't, no, we already had
Oh,
it.
man, sorry about that. I withdraw that motion.
Thank you. Thank you. Next would be the committee report from Ms. Quasny.
Thank you. So since our last meeting in December, the trust has paid out $681,609.29 for different capital calls, and listed below on the report gives you the fund and the amount of money that was sent for the calls. The next item for administrative expenses, there was one payment of $26,971.30 that went for investment consulting for Marquette. Lastly, I have the meeting calendar dates for 2022, and that's April 29th, June 24th, August 26th, October 28th, and we end on December 2nd. Thank you.
Thank you. Look for a motion.
I'll make a motion to accept the administrator report for February 11th, 2022.
Second.
We have a first and second. All in favor, vote aye.
Aye.
Ayes have it. Motion carries. Thank you, Ms. Quasny. Now, next on the agenda is new business. From SORP, LoSAP, and OPEB funds moving from PAYGO to self-funded.
Jeanette,
Okay.
did you want to introduce the?
Sure, I can. Mr. Ritchie, if you'd like to come forward. I think this is, we're kind of getting to is where we're, in the June 30, 2021 audit, it showed that we are now fully funded with the OPEB. That's like one of the big questions. And we actually have an asset. So we were just kind of wondering, in your perspective, Mr. Ritchie, is when do you think that we can start using the trust to pay for the current retiree premiums? When's the safe time, and how much, if you could give an estimate?
I mean, if you're fully funded, I would start completely paying from the trust. So,
Thank you. Sorry. Did you guys hear that? Did you? Now, look.
I mean, how much are you paying out of general funds versus the trust for
3.9
payments?
million.
Right now is, for the current budget, 3.9 million.
Yeah.
And then we have the last actuarial that says, and I don't know if you have a copy of our last actuarial, that says that for 2023, the budget that we're going into says that we should be paying about 4.7 million.
That's what's confusing us, or at least this commission.
To cover our, so that's how much it says our benefit payments are, or expected to be, but how much should we be? Normally, we're covering from our general fund budget the amount that we need to pay for the benefits. So if we're fully funded, do we need to,
Allocate 4.7.
or should we
Can we
use
stick
the
with
entire
4?
amount from the trust?
I mean, you could start, since you're fully funded, I would start paying benefits from the trust. And then you're going to continue to accrue
Interest,
somewhere around 4 million in costs each year. That's what we call the normal cost.
right.
For employees working an additional year and sort of getting closer to earn the benefit from an actuarial basis. But, so you've been paying part from some of our clients pay completely from the trust and always do, even while they're trying to fund it up. some to fund it up quicker will just add to the trust till it's funded and then start paying out of it. But,
Again, what we've been doing is we've been trying to get to that. We've been chasing that number.
right,
And we finally caught that number.
Right.
Now, what I will say about our ability to double our portfolio is we forward funded this trust early in its inception, 2008.
Right.
And that number back when I was elected in 2014 was 18 million over what we should be. And what I've found with that is that 18 million, along with the number that we have in there, has also doubled. So we've had that great return on that overage. Where I'm going with this, sir, is that we're over now about in the neighborhood of $16 million.
From our audit, I'm sorry, I just wanted to show him where we were.
Yeah, go ahead and, yeah. I know, I get hung up in the weeds here. So,
no, go ahead.
all right, as long as you're good.
So we're more than fully funded.
Yeah, we're over fully funded.
Yes.
So the key gets to be, is what we're going to be able to appreciate is the money that we make, the return that we make on that overfunded. And while I see the number, okay, let's look at 4 million, this commissioner wants to recommend to other commissioners that we start taking the 3.9 that we're taking out of general fund and take it out of this trust. Now, one commissioner last meeting said, government involvement in trust usually ends in catastrophe. And my point is, okay, Enron did that, WorldCom did that, but that's what kind of brought about GASB 45. My question to you, sir, is do you see a lot of failures in retirement funds that start paying out? Are the failures predicated on, okay, you got to everywhere you're supposed to go, you got to your goal, and you started paying out and you failed? Or you got to a portion of your goal, you start paying out and you failed? What is the experience that you know of failures of retirement funds?
So there's kind of a two-pronged question here. So the whole point of the trust is to pay benefits.
Really?
So at some point, you got to pay benefits out of the trust. So Enron, WorldCom, that's something different. Enron and WorldCom, they weren't taking out money to pay benefits for participants. They were,
We know.
yeah, dipping in.
But when people
Dipping
showed up to
into an
get their
appropriate-
retirement, there was nothing in there.
Right. You know, they manipulated the stock too, but, and they made it all in stock, so they just made it worthless. So the whole point of the trust is to pay benefits. And the whole concept of pension, OPEB, or whatever is you fund that money in the trust while the person's active, and then you have enough money when they're retired to pay that money out of the trust to pay for the person. Now, a lot of what happened is when we hit the sort of what's called the lost decade from 2000 to 2010, we were assuming all these trusts would get 8% returns, and they didn't. So they fell behind. So we had to make up for it. So what a lot of governments do, in particular with OPEB, it's like, well, we're saying we have to make a $4 million contribution to get the trust funded, but we're going to pay out $4 million in benefits, so let's not do that. Or let's say we have a $6 million trust fund contribution to make, and we got $4 million we're going to pay out in benefits. Let's just put a net 2 in the trust and pay the $4 million outside of the trust and let the trust build. But you've gotten to a point, so my point is you have two decision points to make. One is, do you start just paying out of the trust, which at some point, yeah, you got to start paying out of the trust. The second decision point is, how much, if any, do you want to continue funding into the trust? Because the trust is going to continue to increase in liability as you have more people earn benefits and get benefits from
And let me
the trust.
interrupt you there, sir.
Yep.
And I apologize. My point is this, is the money we have in there is, if it's predicated on a 6% return or whatever return that seems to be the number I remember, 7% return. And it's gotten to a point where it's doing at least that, or let's say it starts doing 4%, or a little bit less. It still gives us the money we need to make the payment without dropping the amount into the fund. So what we've done in St. Mary's County is we have a policy on fund balance, that we keep a 15% fund balance to keep our bond ratings try and keep ourselves liquid there. My goal, this commissioner's personal goal, is to establish a policy for our OPEB amount. And that amount, whether it be 106 million, 109 million, or whatever, that we don't get below that, and that we don't start funding it until we get below that. Let's say it goes to 104 and our policy is 106. Well, we're going to fund it. But while it remains above this goal amount, that we do not fund it. What do you see in that? Am I wrong? What's wrong with my thought process?
Yeah, I think the concept makes sense. You know, the numbers are sort of volatile, so we're taking a guess at what the value is. So there's a risk of overfunding, and then you sort of, what we call trapping the money within the fund.
Yeah, well, we can use the money to return. Look, what I want to do, what this guy wants to do, is I want to lower our income tax rate.
Right.
Because I believe that helps everybody who pays taxes. I also want to lower our homestead tax rate, because that helps people on fixed incomes, people who've paid their mortgages off, and the poor people. That's where I think the people are being impacted the worst by inflation, because those low-income people, those elderly senior members, that when they get that tax bill and it's gone up, whatever it's gone up, and they're saying, I don't intend to sell my house, but these assessments have gone up. It's a guy like me, it's my job, it's the commissioner's job, to keep that amount down on those people so they don't get impacted as much. But what I don't want to do is have someone say, government involvement in retirement accounts results in catastrophe. That's what I kind of.
I mean, I don't agree with that statement. At some point, you got to pay money out of the trust. That's what the trust's for. The trust is there to pay benefits. And that you're fully funded, you should be, you know, ideally how it would work is if you're fully funded, you're paying all medical claims, payments, premiums out of the trust, and then you're funding an additional amount for any increase in the liability above the assets, or whatever target you want to fund to. Like we were talking about earlier, I think we've rethought recently, Kevin's written a bunch of articles about it, that for OPEB plans, because they're so volatile, the liability can go up.
To an 80.
Commitment's hard to predict, that 100% maybe isn't the right target. Maybe an 80% target is better.
Well, do you give any directive, do you give any management advice to that effect? Does Bolton say, St. Mary's, you've been a customer of ours for a long time. We started this process back 13, 14 years ago.
Yep.
We are now at this point in the process. You may want to consider going, ratcheting back, or whatever term. I'm using my terms. But
Yep.
Because it would be helpful as we go into the next budget season, which is getting ready to crank up with our budget workshop on Tuesday.
Uh-huh.
But March is when we really take this pizza pie, in my opinion, and cut it up.
Right.
And the pizza pie being is the amount of money that we have available to us.
Yep.
So I would like to be able to say, we can take our OPEB obligations that we've been paying out of our retirement obligation, which we've been paying out of general fund, and we can start paying them out of our
Trust.
OPEB trust.
Yep.
And then rechannel that general fund money to tax payments. Now, look, I'm one guy, I got to get two more. But the key gets to be is that we start returning, amenities or investments to our constituents. That too much?
No. It makes sense. I think you're on the right track. I think that's a prudent approach. I'm sort of coming in as a substitute. I'm coming in as a substitute, so I'd like to go back and.
I wish I had Kevin here.
Yeah.
Me and that guy have duked it out a couple times.
Yeah, he's told me.
Much said it all. You said if it's fully funded, we should start making payments out of it, so.
Right. The question is, what should
Continue
you
to
put
pay.
back in the trust, if anything?
Well, I kind of like Mike's idea of setting a bar. If it drops below X dollars, then we start funding it again. But there's really kind of no point in having this huge overage.
Right. I mean, I think we can look
Yeah, no,
at
I agree with you, and I
maybe
think.
looking at the prior year final audit. And right now, the 2021 audit showed that were overfunded.
Yeah.
That would be the indicator. So when you're doing, like, a lot of things, we're working on the 23 budget now. Our last audit showed that we were overfunded. So then that would be an indicator where, okay, you used the money from the trust. When it starts dropping and we get back to
we
below,
know. Yeah.
then that would be the time.
See, and we could use a statement from you, something to that effect. Not that I'm saying it's got to say that. It's got to say your words.
Right.
But-
Yeah, no, we could, I mean, essentially what you're asking us to do is what I would call a funding policy study.
Right.
So,
Well, we don't want to spend $35,000.
yeah, no, we can do it cheaper than that. But,
34.
no, we could probably do something simple. We can make a recommendation.
that would
I'm
be
just,
nice.
honestly, I'm just not prepared to do that at this time, but I
No,
think.
but I was prepared, and I don't mean to be so aggressive, but I am passionate about this.
Yeah, no, I agree with you. You should start, you're overfunded. You should start paying money out of the trust.
I mean, it's bad business just to leave that money sitting there, isn't it? I mean,
Oh, yeah, no, you have to pay it out of that's what it's
Yeah,
for.
That's what it's
Otherwise, you'd never use it and it would be there forever.
And we collected it from.
Liability would go away.
I mean, money came from taxpayers.
Right,
Yeah.
right. The point of the trust is to use it to pay benefits. So if you've just been paying outside of the trust to fund it up, now you're funded up, you should start paying money out of the trust.
Right.
I just don't know so say, what happens if you start paying out money out of the trust now and you never put any funding in again, it's gonna deplete and you're gonna have an unfunded liability.
But
or
we're
a
going to
big one,
make,
right?
it's not so much going to deplete, it's going to continue to accrue, that's my term, that's probably not right, by making the return on investment. If it gets us 4% and makes $5 million a year, then it
We
pays for
assume
itself.
that the liability grows at the same amount.
Right.
Well, that's the ticket.
Right.
That's the ticket I was wanting to talk, I shouldn't say the ticket. That's the nexus I want to talk about with, say, the Board of Education. So the way we keep that liability amount from growing or growing disproportionately is keeping an eye on the number of people we hire. Is that correct?
That you, yes, to some extent, yes. So the way it works with so I'm going to try to explain how we value it, how the liability works in total. So,
Well, just tell me this. If you hire more people, you're going to have to hire higher liability.
yeah, if you hire more people, you're going to have what we call additional normal cost, and it's going to increase your liability. So the accrued liability we have and what we're saying is fully funded will pay off benefits that you have already promised. It doesn't account for new hires coming in. So if you stopped hiring people today, and you started paying out of the trust, it would cover benefits earned through today.
Okay, maybe where I'm going with
For the
this
rest.
is to understanding what would be a reasonable rate of growth of, say, government, growth of people, because government is people. So my thought process is that, like, last year, they wanted 97 more people. Now, we ended up hiring 56. Now, this year, I'm sure there's going to be another request for more people, because we can all do a better job if we have more people. So I'm not trying to dispute that. I'm just trying to say, if there was a growth rate that we could talk to that would control our OPEB rate, that we don't shoot ourselves in the foot by saying, well, we hire 90 people. Well, we didn't know that the liability was going to go up so much. If it was some kind of a parameter for us to wrap ourselves around of growing government 2% or 3%, that would have a direct impact on liability amounts. That would be helpful for this commissioner, if that's even possible.
Yeah, it has to be possible. I mean,
Well, yeah, so,
Guys got to do it. I dream it. It's like a builder I have. He says, Mike, you can dream it, but I got to build it.
so I can project liabilities going forward, what they would be based on certain growth rates you would have and adding people to it. So I could do, like a 10-year projection and show you, like, if you had a 2% growth rate in your population, what impact that would have on the liability. But, so when we value the liability here, what we're valuing is just employees employed today. And providing employees employed today who we assume is going to retire, collect a benefit, and how much they're going to get. So the goal of what we're doing in the funding is we want to fund it while you're getting the service of the employees that you're getting. So we're trying to tie the cost to the benefit you
While you're
get
getting
from the
the benefit.
employees, right? So this is what we call the normal cost piece. So what we do, let's say somebody's hired today at 25. And I assume that person has a certain chance of working till 65 and getting a benefit. And if the probability they work till 65 and get a benefit, the value of paying their medical for whatever the plan is at 65, say it totals up to $300,000 at age 65. That's the value of the payments we're going to make out. So what we want to do for 25 to 65 over the next 40 years is I want to fund an amount each year so that at 65, I have $300,000 to pay for that person's benefit, and I don't have to take any money out of my pocket while they're retired. I've fully funded them. So say I'm funding, 10 grand a year to get to there. So what the accrued liability is, let's say I'm 20 years into that person's career. The accrued liability is I've saved $10,000 for 20 years, and it gained some interest, I got $200,000. And my target is to get to $300,000. So I haven't fully funded that person's benefit yet. So if I just stop funding that at $200,000 while I'm 20 years into a 40-year career, and I stop funding, that'll grow with interest, but maybe that grows with interest to $250. It doesn't cover the $300, so I haven't fully paid for that person yet.
Liability.
So I have to keep funding. That's what what we call the normal cost is. That's that annual payment I'm making for the person, so by the time they retire, I have enough money to pay for their total benefit. Now, if we look at the retiree portion of that liability, yes, I shouldn't be paying anything in the fund. If I'm fully funded, I don't pay anything into the fund to fund those people. I have enough money to cover their benefit, assuming my assumptions are correct.
I'm sorry to interrupt you, but Catherine, tell me, do we have, in this day and age where I've seen it with my own children, where they tend to get a job and jump to another job and, it doesn't seem to be that people like get a job at 25 and say, I'm going to be here for 40 years. It just seems to be more volatility in that, in my opinion. Do we keep an idea of what the average length of time an employee works for us? I know we have 40-year employees. We have 30-some-year employees.
I can certainly do that.
But if someone joins at 25, or comes into workforce in their 20s, does it necessarily mean they stay till their retirement age?
So what we see now is a lot of people retiring with benefits, and then we're hiring, and we're struggling hiring, and we're hiring, and those newer hires may not stay as long. But we certainly have.
But add to how we do the valuation, we take that into consideration. So for this one person, we need 300,000, but we're not going to fund 300 for every person, because we're going to only assume, say, 50% of the people are going to make it there and get it, and the rest are going to leave beforehand. So for each person, when we need to fund a 300, we fund 150 to each person, assuming,
There's a bunch that won't get there.
yeah. And that's what we do. So, should you start paying benefits out of the trust? Yes. If you start paying benefits out of the trust, people are still we haven't funded everybody's full retirement that might get there yet. So it will deplete at some point. So I don't know that we want to stop completely funding.
Well, again, it gets to be when to fund.
Right. And to what level do we want to fund to? Because we make a lot of assumptions. And I always say, actuaries are always wrong because we
They are.
don't
I
we don't
agree.
assume, but we're reasonable.
I'm sorry to be so hard on you, but you guys have too much control. But again, what I'll go to, and I know we're getting late. If I were to ask you, at least I'm only one guy here, I'd go with that 80% number. That when we talk about having this policy number, sounds like we were always wanting to be 100. Now you guys are talking about you're comfortable with 80. maybe what we do is adopt that 80 as our number. Because that gives us a lot of flexibility from where we are to where we would be, and make it a little bit easier, at least for whoever comes after me to, I always say you can run things when you got plenty of money.
I guess my question is, St. Mary's County seems to have, what, approximately 600 full-time employees? And last year, we hired almost 50 new FTEs, which is 50, what, that's almost a 10% increase. So taking that into account, you know, where are we in the 100% or the 80%,
Well,
right?
just to chime on to what you're talking there, David, is what's happened to us, what really impacted us last year was the EMS.
Oh, absolutely.
Losing the LoSAP people, losing the volunteers, and now going with career.
Sure.
So with that said is, what do we look at going forward? Could it happen in fire? It definitely could.
Right, right. But I guess my thought is if since we've just added 10% to the workforce, you know, our numbers, our actuary numbers, you know, have to be adjusted in the next year or two, right?
So what happens when somebody's hired, they really technically come in with no liability because they just started working.
Right.
So we're just starting to fund for them. They come in with what we call the normal cost piece. So we say, we've hired, 50 people. Well, we're saying for 50 people on average, we think for those 50 people, by the time we retire, we're going to need, $3 million. So we're going to recommend if we look at how long the average length of their career, if it's 20 years or whatever, we're going to need, $5 million. We'll start, maybe funding $500,000 a year, or $250,000 a year, or whatever to get to that target. So we'll say you start funding for those people, this is how much you fund.
Right.
And that's what we call the normal cost piece.
Okay.
But, yeah, you can fund it to 80. Like I said, I haven't dug it enough. I'm sort of a replacement in here for Kevin. But go back and talk to him, and I think we can come back with a recommendation on what you should do.
Okay.
But I think you're
Is
right.
that
I think
okay with everybody else? I don't know anything about me.
Yeah, it makes sense to me.
I think you've had a good return. You should certainly ratchet down
Right.
quite a bit.
Right.
But to help us with some kind of a policy on what we
Yeah,
should be able
yeah.
to follow,
Right,
when to and when not to.
right.
Now, the next meeting is the 29th of April.
Right.
So for the budget process, does that work?
Well, I think what we're going to do is we shoot from the hip in this budget thing anyway. I mean, we'll talk about what, I hate to say it that way, sir, but we got commissioners to say, well, 3 million, I want to go 2. Growth rate, the state says 5 points, I want to go 4. I mean, it's just scatterboard. But going forward, what would be helpful for at least this guy is to gain a sense of comfort myself.
Yep,
Because, I don't feel like I can input well enough unless I'm comfortable.
right.
So if it's April, it's all about timing. If we don't get it this year, next board will get it next year.
Okay.
All right. We'll work-
Thank you.
I'll touch base with you next week.
Thank you.
Thank you very much.
Sure.
Do we need a motion?
No.
No, we do not. Next bit of business is to say, again, thank you very much to,
Oh, Mr. Ritchie, you probably have to leave, so we'll let you go, but
Oh, okay. well, I
thank you for taking it on the chin like you do. You did.
Oh.
Did a good job.
This is my job. This is.
As long as you're
Here to
okay.
advise you.
My heart's in
Ask
the,
me, I don't have anything to do.
and tell Kevin, my heart's in the right spot.
No, you're asking good questions. These are the things you should be looking at. These are the things
Right.
I'm not taking it as an attack, so maybe I'm missing something.
thank you very much. And as I was saying, we really do wish Mary Ann Murray the best and thank her for all her time and hard work on this board as well as the last board, and look forward to seeing her in the future. And we also want to give, again, a front-loading certificate of appreciation to Mr. Scott Ostro for joining the board.
I'll make sure I get this back if I don't show up again.
And Mr. Ostro, that certificate of appreciation is presented to Scott R. Ostro for your service on the Retiree Benefit Trust of St. Mary's County. Your diligence, dedication, and relentless pursuit of excellence has earned the community's gratitude, respect, and admiration. We thank you for your commitment to the betterment of St. Mary's County and its citizens. This date, February 8th, 2022, signed by the Commissioners of St. Mary's County.
Thank you, Commissioner. My privilege to serve on this board.
Good. And next, I will look for a motion to adjourn.
So moved.
Second.
Have a first and a second. All in favor, say aye.
Aye.
Aye. Motion have it. Motion carries. The ayes have it. Thank you.
Thank you.